Central banks across the world are now starting to cut interest rates, begging the question, could we see the Federal Reserve in America do the same? And will this cause a reignition of inflation and cause home prices to go up further? With the Bank of Canada, as well as the European Central Bank cutting interest rates for the first time in 4 to 5 years. And so many people are asking the question, like, are Jerome Powell and the Federal Reserve going to go ahead and follow these other countries in cutting interest rates in 2024? And the answer is, I don't think so, at least not yet. Because we can see the inflation rate in America is still stubbornly high. It's around 3.4% year over year inflation, which is still healthily above the Fed's 2% inflation target. So it's this yellow dotted line that the Fed is targeting in terms of inflation, and we're not really there yet, and we're not showing clear progress to that 2%, which has now caused many of the Federal Reserve governors, whether it be Christopher Waller, Michelle Bowman, or other people at the Fed, they're starting to say things like, yeah, we're going to keep it higher for longer until we see more definitive progress that inflation is getting down to that 2% rate. And you can actually see that the betting markets are also thinking that the Federal Reserve is going to hold off on cutting rates. They think that in the next meeting, 99% chance they keep rates the same. July, they think it's a 91% chance they're going to keep rates the same. And then it's kind of in September, everyone, when the betting markets think that we might see maybe this first rate cut in September. 45% odds of a rate cut in September. And then by December, the end of the year, they think it's 15% odds rates stay the same, 40% of one rate cut, 34% of two rate cuts. So what the betting markets are saying right now is no imminent rate cuts from the US Fed, but we could see 1 to 2 by the end of the year. And so this is potentially like a baseline expectation. There's also still the chance that the Fed might have to increase interest rates as well in case inflation doesn't really fully get under control. We're seeing the cost of a lot of core inflationary items actually start to reaccelerate. And so a lot depends on inflation and a lot depends on the economy, everyone, because the Fed has a dual mandate. One is price stability, the other is maximum employment. And we're starting to see the maximum employment side of the ledger weaken. We just had a jobs report from the Bureau of Labor Statistics that said the U.S. added 270,000 jobs. However, digging deeper into that jobs report, you can actually see that the unemployment rate went up to 4%. This is the first time the unemployment rate has been at 4% in 2.5 years, more or less. It's the first time the unemployment rate's been 4%. So we're starting to see this continual gradual increase in the unemployment rate, with the unemployment level in America, the number of unemployed Americans spiking up to 6.6 million. So you have 6.6 million unemployed Americans, which is about 500,000 more than it was a year ago. So despite the fact that there's still semi-strong headline jobs numbers, we're actually seeing the number of unemployed people increase. And you talk to anyone looking for a job right now, they will tell you the job market is not good. I mean, I know a bunch of people who are looking for jobs right now in different industries related to real estate and tech, as well as finance. It is very difficult to find a job in those industries right now. And I think there's a big disconnect between what people are experiencing on the ground in the economy and what kind of the conventional reporting is on the economy. The more people I talk to on the ground, the more people I hear say that things aren't good. The more people I hear, say things like I just got laid off. It's hard for me to find a job. And sure enough, everyone, take a look at this data from Indeed. Indeed's hiring lab, the job posting website. They're showing that the job index is down all the way to 112. This is the lowest it's been in terms of job openings since March 2021. It's down 14% year over year, and it's just continually trending down. This is the number of job postings on Indeed. Now, it's still 12% above what it was before the pandemic, but in the post-pandemic, we were peak at 64% higher than pre-pandemic. Now we're at 12% higher. It's just continuing to drop. And so I think at some point, everyone, later this year, the labor market might crack. We're seeing that slowdown. And if the labor market cracks, we could see the Fed be forced to do some type of emergency pivot and cut rates earlier than expected. Of course, this is the one kind of variable that's hard to predict because the Fed right now and the betting markets are assuming like 1 to 2 rate cuts end of the year. That's assuming that the economy kind of stays as it is. If the economy were to take a nosedive, the Federal Reserve were to maybe have to cut rates a little bit earlier. And then, you ask the question, what would happen in the housing market if the Fed did that? If the Fed had to cut rates earlier than expected, or maybe they just do 1 to 2 rate cuts, what would that do to home prices? Well, let's answer that question. And to answer that question, we got to look at mortgage rates, everyone. Where are mortgage rates today, and where could they go in the future if the Federal Reserve cuts interest rates? Well, today we're around a 7% mortgage rate, everyone. 7%. And what I have baked into this orange line is like maybe a projection. Like if the Fed cuts rates 2 times at the end of the year, that would get us down to a 6.5% mortgage rate if the Fed cuts rates 2 times and if inflation cooperates. Those are two big ifs. But maybe we could see, best case scenario, 6.5% mortgage rates by the end of the year. So you'd ask, what would that do to the housing market? And there's some people out there who think, well, if the Fed cuts interest rates at all, home prices are going to go up. I hear a lot of realtors and mortgage brokers say that. A lot of real estate investors just say, like, just wait for those rate cuts. That's going to just bring all this demand back into the market. But realistically, folks, cutting mortgage rates from 7 to 6.5, it's not going to really do anything for the housing market because the affordability is so bad right now that, yeah, okay, a 50 basis point reduction in mortgage rates, that's going to save you like 8% or 9% on your monthly payment. Not that meaningful when the affordability is so bad. Rather, to see true progress, we're going to see mortgage rates go from 7 to 5. Like if we saw mortgage rates go from 7 to 5, I think that would bring buyers back in. But 7 to 6.5, I don't think so. And the other thing to think about, everyone, is like, what happens when mortgage rates decline historically? This is a perspective that's also very important for you to have as a home buyer and investor. Because you got to understand, like, well, why would mortgage rates decline? Well, typically, mortgage rates decline, everyone, in periods of recession. Like, if we take a look at this historical graph of mortgage rates going back to 1971, we can see obviously they went up in the 70s and 80s because of the crazy inflation. But since then, mortgage rates drop during these periods of gray bars, recessions. Uniformly, during a recession in the last 40 years, mortgage rates drop, right? I mean, in the last crash, they went from 6.5 down to 4.8 during that last crash. Didn't do anything to stimulate the market. And so now we're here at 6.99. Yeah, maybe mortgage rates go down a little bit in the next year, but there's a good chance that that is correlated with some type of economic downturn. And if it's correlated with an economic downturn, do not make the mistake of thinking that mortgage rate cuts are automatically stimulative. Rather, think about it from this perspective. The unemployment rate today is 4%. It's gone up a bit over the last year, but that's still very historically low. And it's unlikely that that unemployment rate persists. So what were to happen if the unemployment rate were to go from 4 to 7%? Let's just think about that type of environment. The unemployment rate were to go from 4 to 7%. That means that the number of unemployed Americans would go from around 6.5 million to 10 million. An additional 3.5 to 4 million unemployed Americans if the unemployment rate were to go from 4 to 7%. And then you got to ask, well, what would that do to housing market demand? And what would that do to supply if all of a sudden 4 million people lost their job? Well, that would lead to more foreclosures and evictions and more supply hitting the market. And so the reason I'm going through this type of hypothetical analysis, everyone, is so you guys can kind of establish these different frameworks for what might happen and not necessarily just automatically get duped into thinking, the mainstream narrative of like mortgage rates down mean that like the housing market's going to boom again, because that is definitely not clear, especially in certain parts of the country. But boy, everyone, I have some concern here over some of these Sunbelt housing markets, these housing markets in blue. These are housing markets with a Reventure app home price forecast score below 50. We can see Tennessee is one of these housing markets. Tennessee has turned from a seller's market to a buyer's market. The inventory is spiking, the price cuts are spiking, and it's just continuing to kind of trend down into a buyer's market. Like, I think if you see that in your area, like in Texas, we can see the home price forecast just trending more and more into a buyer's market, which is, it's good. That's good for you as a buyer, but it's sending you a warning that if we're already trending into a buyer's market due to spiking inventory and price cuts, if the unemployment rate then goes up and spikes by a lot, that could lead to like a decline that's much even bigger than what we're seeing now. And so one thing that you all should do out there, if you haven't done it yet, is go to www.reventure.app and make sure to look at this home price forecast score. You got to sign up for a premium membership to access it, but it's well worth it, everyone. You're going to want to look at what this score is for your metro and your zip code to see kind of where the directional tilt is of home prices in your area. Is your area like a zip code in red where prices are still going up and are likely to go up? Or is it like a zip code in blue where prices are likely to go down due to excess inventory and supply? It's so important for you to arm yourself with the answers to those questions as a home buyer and investor so you can make a more informed decision in 2024. And actually, folks, since we mentioned Canada earlier, I want you guys to check this out. What's going on in Canada's housing market? Because, while it's our neighbor up north, it's not necessarily exactly related to what's going down here in the US. I think this is worth seeing. You can see, according to reporting on Wolf Street, home prices in Canada have actually dropped by quite a bit the last 2 years. They're down by 14% from peak and where it was back in September 2021 now, with the biggest declines taking place in Toronto, Hamilton, where values are down 20%. You can see Vancouver is actually performing better. Prices in Vancouver are actually up year over year, but that's because they didn't go up as much during the pandemic. Prices in Ottawa are down. Interestingly, prices in Calgary are way up. I think this is due to oil or something like that. If you're in Canada, you can let me know why you think prices in Calgary are way up. But in general, most parts of Canada, the home prices have gone down by a lot, by around 14-15% from peak. Canada seems to be a bit ahead of the US in its housing cycle. The prices have dropped by more, the unemployment rate's gone up by more, and so their central bank has decided to cut rates earlier. This could be a window into like what's going to happen in the US the next 6 to 12 months, maybe higher unemployment rate, home price declines, and eventually the Fed is forced to cut. Now, what about over in Europe, everyone? Check this out. A report from the UK is showing that home sellers are flooding the property market just as buyers walk away, with the stock of homes for sale at a 3-year high, with UK home prices falling the most in 8 months. Experts said that weak supply was partially responsible for the resilient home prices seen last year in 2023. However, now a boost in listings could have the opposite effect in the UK at a time when the house price recovery and buyer demand are faltering. I mean, that sounds incredibly familiar to what's going on in the US housing market, everyone. There was this head fake in 2023 of a recovery due to a shortage in new listings and lower inventory. It caused prices to start to go back up, particularly in certain parts of America. But now we're seeing the listings increase in the US and we're seeing the buyer demand stay near 20, 30-year lows. And the inventory, well, it's starting to pile up. With active inventory on the US housing market, according to Realtor.com, surging up to 788,000 listings in May 2024. You can see that this is the highest level of inventory since 2020. It's way above where it was during the pandemic. It's 35% higher than last year. And it's now starting to get to those pre-pandemic levels. And so it's interesting to me how like the world housing market kind of all going in the same general direction. Maybe Canada is a little bit ahead of the US. Maybe the UK is also a little bit ahead of the US. But in general, we saw a 2023 fake recovery in all these countries. Now we're seeing prices go down again and inventory spike. So if you're a home buyer in America especially, go to www.reventure.app. Check out that home price forecast score for your area, everyone. You can see in a market like Denver, it's a 34 out of 100. It's plummeting into a buyer's market. Prices in Denver are now starting to drop, will likely drop more into the future. Look at the monthly home price forecast score month by month. You can really get a sense for the trends. And if you see it just dropping like this, it's like, oh my goodness, this market's shifting down. Conversely, you head to a place like Chicago, you open up the home price forecast score, you can see it's actually going up, right? More of a seller's market. So if you see the home price forecast score going up, more of a seller's market, prices stable or going up. If you see it going down and free falling, like in Tampa, be very, very careful. Prices could be dropping fast. So find out what the home price forecast score is for your zip code and county on Reventure app right now.